I am Mr. P.R. Venugopal. I am from Department of Commerce. Today I am going to deal with admission of a partner. Okay, for dealing admission of a partner, one should know what is the meaning of admission of a partner and also the points relating to it to do the problems. So what is the meaning of admission of a partner? Admission of a partner is nothing but whenever a new partner joins the existing partnership business, it is referred to as admission of a partner. Okay, one should know the following points for doing the problems under this topic. So I am writing out the points which we need to consider for solving the problems under this topic. Point number 1, calculation of new profit sharing ratio. New profit sharing ratio. 2, calculation of sacrificing ratio. 3, treatment for undistributed profits or undistributed losses. Undistributed losses. 4th, treatment for goodwill. Treatment for goodwill. 5, treatment for revaluation of assets and liabilities. 6, treatment for capital brought in by new partner. 7, treatment for adjustment of existing partners' capital. Existing partners' capital on the basis of new profit sharing ratio. New profit sharing ratio. That is, the surplus can be taken away. Surplus can be withdrawn. Surplus can be withdrawn by the existing partner, or the deficit can be brought into the business. One should know the following 7 points for solving the problems under the topic admission of a partner. So the first point we have, let us recall again, new profit sharing ratio. This will be based on the informations given to you in the problem. If the sentence in the problem says that new partner is given 1/3 share, then A and B are existing partners and C is given 1/3 share. Okay, let the total share of the business be 1 and the new share is given to him is 1/3. So left out is 2/3. This 2/3 has to be distributed among A and B at their old ratio 2:3. So if you calculate what is the share of A's share is equals to, A's profit sharing ratio is equals to 2/3 into 2/5, which is equals to 4/15. B share is equals to 2 by 3 into 3 by 5 is equals to 6 by 15. And since the denominator of A and B is 15 and 15 and C's denominator is 3, let's make it C's denominator also same, that is 15. So C share is equals to 1 by 3 into 5 by 5, make multiplication and dividing both numerator and denominator dividing by 5, we get 5 by 15. Therefore the new profit sharing ratio A is to B is to C is equals to 4 is to 6 is to 5. So this is your first point. 4 is to 6 is to 5. So new profit sharing ratio. Now based on this new profit sharing ratio and old ratio, we can calculate sacrificing ratio. Sacrificing ratio is equals to old profit sharing ratio minus new profit sharing ratio. Who is sacrificing? The existing partners A and B are sacrificing. So sacrificing ratio is calculated for the existing partners only. New partner is going to get 1/3 share out of the total share what was existing to them A and B previously. So therefore sacrificing ratio is to be calculated for the existing shareholders only, that is old partners. Okay, let's do now sacrificing ratio. So sacrificing ratio is equals to old profit sharing ratio minus new profit sharing ratio. Okay. So old profit sharing ratio of, that is sacrificing ratio of A. Sacrificing ratio of Mr. A. So how to do that? Old ratio is 2 by 5 minus new ratio was how much? 4 is to 6 is to 5. This was your new ratio. Okay. So 4 divided by 15. So this is equals to 15 is the LCM, 5 3s 3 to 6 minus 4 is equals to 2 by 15. Then sacrificing ratio of Mr. B is equals to 3 by 5 new ratio, old ratio, minus new ratio 6 by 15 is equals to 15 is the LCM, 5 3s 3 3 is 9 minus 6 is equals to 3 by 15. So sacrificing ratio of A and B is equals to 2 is to 3. So if you carefully look at this calculation, okay, your old ratio and your sacrificing ratio is the same. Calculation of sacrificing ratio of A and B, old ratio 2 is to 3, sacrificing ratio also 2 is to 3. Whenever you have a fraction 2 by 3, 1 by 3, 1 by 4, 1 by 5 given for the new partner, we need not have to calculate the sacrificing ratio of the existing partners. Their old ratio, whatever is there, the same ratio becomes the sacrificing ratio. This you can remember and then do the problems. Okay, so let's move on now to the next point, treatment for undistributed profits. In the list already I have given to you. Third point is treatment for undistributed profits. Undistributed profits oblique undistributed losses. Undistributed losses. So let's recall what is undistributed profits oblique undistributed losses. The profits which are existing in the business for A and B, which they have not taken the benefit, retained in the business for future unforeseen accidents. So for such purposes, whatever the profits has been retained in the business which they have earned but not taken the benefits are kept in the business are termed as undistributed profits. Business A and B has earned these profits but not taken the benefits. Such benefits are to be given to them now before the new partner is taken into the business. So examples of undistributed profits are general reserve, revenue reserve, profit and loss credit balance, profit and loss account. So these are the few examples of undistributed profits. Now we need to distribute to the existing partners A and B. So journal entry will be, undistributed profits is normally a credit balance, needs to be closed when you are distributing to A and B. So entry will be general reserve account debit, general reserve account debit to old partners capital account. Old partners capital account meaning old partners here. Who are the old partners? A and B. So you can write general reserve account debit to A's capital account to B's capital account. By writing this entry, old balance sheet, whatever the general reserve is existing in the liability side becomes nil, zero. In the new balance sheet, general reserve will not be appearing after the admission of the partner. So next entry, next one is undistributed losses. What do you mean by undistributed losses? Just an example of undistributed losses is P&L account, whatever credit balance is there, we call them as the undistributed profits. P&L account, that is profit and loss account, debit balance, if it is appearing, debit balance at the asset side of the old balance sheet, then this needs to be closed before the new partner is taken into the business. So for this, journal entry will be A's capital account debit, A's capital account debit, B's capital account debit to profit and loss account. So by passing this journal entry, profit and loss account, what was existing into the asset side of the balance sheet, P&L account, will become zero, nil. So in the new balance sheet, this P&L account will not be appearing. So in the new balance sheet, this P&L account will not be appearing. So the old partners have taken care of the losses which were existing in the business. Now the new partner is not going to ask. Okay. So this is the third point, undistributed profits and losses. So now let's move on to the fourth point, treatment for goodwill. This is again very, very important, both from the examination point of view and practical point of view. So treatment for goodwill. Treatment for goodwill. Treatment for goodwill. What is goodwill? Goodwill is nothing but if an item is actually worth 100 rupees and if somebody is willing to pay 130 rupees for that item, so the difference 30 rupees is paid for goodwill. Price paid for the product. Like for example, if you take a what is that example? Arrow shirt. Arrow shirt is 2000 rupees. The same shirt, same quality, same color, everything, if you stitch it, it will be costing you 1000 rupees or 1500 rupees max, 1300 rupees let's say. Okay, so the difference is 700 rupees. Person who is willing to pay 2000 pretty well know that he can get it if he stitched it for 1300 rupees, but still he is willing to pay 2000 rupees because of the goodwill, because of the brand. So the brand, whatever he is paying extra money, 700 rupees is nothing but the goodwill. So in the similar way, then how this is goodwill is there in the partnership. Both A and B started business. They have put their time, they have put their efforts, they have put their money, everything, and they have existed in the market for some period. In this period of stay, they have brought some customers to the business. They have created some customers for the business. So if C is taken into the business, he is going to join the existing business of A and B. If he is sharing the profits, that's okay. But what about the compensation for the goodwill? For the efforts what they have put in, for the time what they have put in, for the money. Of course, money is also now is also putting, C is also bringing money into the business, but the time and the efforts which A and B have already put in, C is not going to put any kind of time and efforts for the past period. So that compensation today we are going to give to A and B, that C has to pay for these two things, and that is what technically we call as goodwill. Okay, so that goodwill what he is bringing, there are two methods for this. Okay, goodwill brought in cash, goodwill brought in cash by new partner C. If C is bringing goodwill in cash, that needs to be distributed to A and B. Okay, so entry cash / bank account debit to A's capital to B's capital. This is after bringing. I am not discussing the entry that is cash account debit to goodwill account. Cash account debit to goodwill account. You may use goodwill, you may not use goodwill, you can even write C's capital account. Some people avoid using goodwill term. Okay, so you can write C account debit to cash account debit to goodwill, and then that goodwill is distributed to old partners. This distribution is to be done at sacrificing ratio. Sacrificing ratio. If you remember, students, today first point we discussed new ratio, second point we discussed sacrificing ratio of A and B. This sacrificing ratio, what we calculated in step number 2 or point number 2, is used here. When the new partner is bringing goodwill in cash, that needs to be distributed among the existing partner at their sacrificing ratio. So please remember, A is contributing some portion out of his profits, B is contributing some portion of his profits to C. So C is getting 1/3. This 1/3 information is not available to us in the problem what we discussed today. Okay, how much A is contributing to it, how much B is contributing to this 1/3, we do not know. On an aggregate basis, 1/3 C is given. So this 1/3 is given to C just because A has sacrificed, B has sacrificed out of their share of profits. That is why there is a sacrificing ratio of A and B. Okay, so at this ratio you distribute the cash brought in the form of goodwill by new partner to A and B at the ratio what they are actually losing. This is also called as losing ratio. Sacrificing ratio is also known as losing ratio. Okay, then this goodwill is not, not to be shown in the new balance sheet. When the goodwill is brought in cash by the new partner in the new balance sheet, normally goodwill appears in the balance sheet asset side, but when the new partner is bringing cash into the business in the form of cash, goodwill is distributed to A and B, that goodwill cannot appear in the balance sheet. As per New Companies Act 2013, Companies Act will not be applicable to the partnership, but as per the new rules given ICAI book, okay, the purchased goodwill only appears. Remaining, this treatment is called as premium, goodwill brought in premium. So this will not be appearing in the balance sheet. Okay, now let's move on to the fourth point, that is treatment for revaluation of assets and liabilities. Liabilities. Treatment for revaluation of assets and liabilities. Revaluation. What do you mean by revaluation? Revaluation is nothing but re and value. Okay, so already asset is existing, you have valued it and it is appearing. You are doing revaluation. That means you are recalculating the value of the assets and the liabilities which are already existing in the business. This is for what purpose are we doing this? This we are doing because the new partner C is supposed to bring in a sufficient amount of capital which A and B already brought long ago. Okay, and with that money they have purchased all the assets and liabilities in the business. So these assets which have been procured long ago, okay, today market value may be different. Some value may be reduced, some assets values may be increased. Similarly, liabilities also, at the time of taking loan it may be more, okay, after the pass of some time some amount has been repaid, so today it may be existing less. So there is a need for us to recalculate the value of assets and liabilities, and that's why we call revaluation of assets and liabilities of the business, of the partnership business. So therefore C is waiting for these things to happen because he wants to join and he wants to know how much he is supposed to bring into the business, what money he is supposed to bring into the business. The partners are trying to explain the new coming partner, old partners are trying to explain to the new partner that these are the assets and liabilities which we possess, by our hard work we have acquired, and the value of the assets and liabilities today is so much. Unless we calculate, we will not be knowing how much is today. I may have purchased this land or for this business, let us say for 2 lakhs from 25 years back or 20 years back. So today the value of the land and the building may be different. What I purchased for 2 lakhs from 25 years back, it may be 20 lakhs, 50 lakhs today. So if I show 2 lakhs rupees and I say 20 years back I started a business with only 40,000 rupees, today if Mr. C is bringing, new partner is bringing 40,000 rupees, it is nowhere sufficient. It is not on equivalent terms. So therefore there is a need for recalculation and try to assess based on this what is the capitals of the old partners A and B. Okay, so therefore revaluation account we do for accounting treatment, in accounting treatment. So to whatever the assets gets reduced, to liabilities increased, by assets increased, by liabilities decreased, and therefore so if this total is more and that total you are bringing here, okay, and the profit is coming here, so this is to A's capital account to B's capital account at their old ratio, So profit on revaluation of assets and liabilities distributed to old partners capital account at their old profit sharing ratio. So this is one entry we write, this is other entry we write, revaluation account I say this one. So first entry we can write is journal entry for decrease in assets and increase in liabilities. So journal entry will be revaluation account debit to assets account to liabilities account. Okay, whatever the assets reduced, whatever the liabilities increased, I have written here. So this entry is taking care of decrease in the value of assets and increase in the value of liabilities. So the second one is journal entry for increase in the value of assets, and decrease in the value of liabilities, So journal entry will be this: assets account debit, liabilities account debit to revaluation account. So assets increased account debit, liabilities decreased account debit to revaluation account. Okay. After that, the difference. If your debit is more, you get loss. If your credit is more, you get profit. So you can write the journal entry, third entry, journal entry for profit oblique loss on revaluation. Profit oblique loss on revaluation of assets and liabilities. Assets and liabilities. Okay. So entry will be case 1. In case of profit, if the credit total is more than the debit total, then you have to write the profit entry. Journal entry is revaluation account debit to A's capital account to B's capital account. Revaluation account debit to A's capital account to B's capital account in the case of profit. Now case 2. Okay. Case 2. Journal entry in the case of loss. That is, the decrease in the value of assets, increase in the value of debts is more than the increase in the value of assets and decrease in the value of liabilities. It's the case of loss. Increase is less, decrease is more in assets. Similarly, in liabilities, increase is more, reduction is less. So your firm is going on taking loans, not paying loans. Then you are getting a loss on revaluation of assets and liabilities. In that case, your entry will be A's capital account debit, B's capital account debit to revaluation account. Okay. So this is the revaluation of assets and liabilities. Okay. This is also a permanent change you are bringing in the books of accounts, and you are going to increase the profits of the business permanently, because the changes what you are doing in revaluation is nothing but this should reflect into the new balance sheet. When you draw the new balance sheet after the admission of the new partner, new balance sheet when you make, in the new balance sheet, assets will come back to the market value. Assets are coming to the market value. Liabilities, assets, everything is coming to the market value. New balance sheet is shown as per the market value. That means you are permanently showing these changes into the business. But this arrangement is internal. You are trying to convince C that the business is having lot of assets and liabilities, and therefore you want the partner, incoming partner, supposed to bring more capital because of the revaluation of assets and liabilities. So this is an internal adjustment. We don't have to show to the external parties why we are doing revaluation. Therefore, there is one more treatment called memorandum revaluation of assets and liabilities. Memorandum revaluation of assets and liabilities. Whatever we have done, memorandum in the revaluation of assets and liabilities, in the revaluation account, whatever we have done, assets decreased, assets increased, liabilities increased, and liabilities decreased. Okay, whatever we have done here, the profit or the loss, that needs to be cancelled, because it's an internal adjustment. We are trying to convince C for bringing more capital. This is not to be revealed to outside parties. In that case, whatever the changes you brought into the value of the assets needs to be cancelled. So reverse adjustment is to be done, and whatever the profits is there becomes loss. Whatever the loss is there, you write as a profit. So yeah. So now journal entry for profit. Journal entry for profit on revaluation of assets and liabilities. Same entry will come, revaluation account debit to A's capital account, revaluation account debit to A's capital account to B's capital account. Okay, then reverse this, entry will be A's capital account debit, B's capital account debit, C's capital account debit to revaluation account. This is old ratio. This is as per the old ratio. The benefit is given to only old partners. This is as per the new ratio. So same entry will come, journal entry for loss. Journal entry for loss on revaluation of assets and liabilities. Entry A's capital account debit, B's capital account debit to revaluation account, to revaluation as per old ratio. As I told you already, first entry will be old ratio, second entry will be new ratio. Entry revaluation account to A's capital account, to B's capital account, to C's capital account, to C's capital account. This is as per the new ratio. So please understand, we are only doing sacrificing ratio at the time of goodwill, and in all remaining other entries we are only either using new ratio or old ratio. Most of the places old ratio only we will be using. So next point, let's move on to the next point. So by doing this entry, what is happening? We are nullifying all the changes that brought into the assets and liabilities to the existing partnership business has been nullified by cutting it off. You see, we credited and we debited. So the net effect is shown in the partners' capital accounts. So real assets and liabilities, we are not going to bring any changes. So in the new balance sheet, if the partners decide that in the new balance sheet nothing is to appear, no changes has to appear, it is the internal agreement for the new partner C to see what is the real worth of the business, we are bringing the changes. After that, once he is getting convinced, or we have shown to him, and then we are cancelling it in the book entries. So this is not revealed to outside parties anywhere. So this is an internal adjustment, memorandum revaluation of assets and liabilities. So let's move on to the next point. Capital brought in by new partner. How much capital he is bringing into the business. Okay. New partner bringing capital into the business. So how much is that? What is that? So they will tell you in the problem. New partner has brought, let's say, 2 lakhs rupees into the business as his share of. C is bringing 2 lakhs rupees as his share of capital. Entry, cash or bank account debit to C's capital account. To C's capital account. This is the entry we are supposed to write. Okay. After that, the last point, that is the adjustment of new partners' capital among the based on the new profit sharing ratio. Adjustment of old partners' capitals on the basis of the new profit sharing ratio. Or sometimes they will tell you new partner capital. As per the statement given in the problem, we need to do. But basically the final conclusion will come only one point, either the surplus or the deficit. Surplus or deficit. This is the 7th point I am dealing with. Treatment for adjustment for old partners' capital accounts on the basis of new profit sharing ratio. On this basis, if we really want to adjust, okay, we can do that. So deficit or surplus will come. This is the final conclusion. Okay. So what we are going to do this. Let's say as per the new profit sharing ratio, A's capital supposed to be 1 lakh. Okay, existing it is only 70,000 rupees. For B, existing is 1 lakh. This is existing. Okay, this is existing. And B's capital is, let's say, 1.5 lakh he is supposed to have. This is as per new ratio. This is as per new ratio. As per new ratio, it's supposed to be 1 lakh, but as per the existing ledger account, it is having 70,000 rupees. So there is a deficit of 30,000 rupees. So which comes under this case. So entry A is supposed to bring rupees 30,000 to make his capital as per new profit sharing ratio. So entry cash account debit, for the business cash is coming in and A is giving A's cash. Okay, cash account debit A's capital, 30,000 rupees is bringing. Yeah. B, let's take a reverse example. Existing is 1 lakh, but both are becoming same examples. That's why I'm changing it. So let us say 80,000 rupees is as per new profit sharing ratio, but existing is 1 lakh. So B is having more capital than what his profit sharing ratio is. Therefore, the surplus money, whatever existing in the business, will be taken away by B. In that case, B will withdraw rupees 20,000 to make his capital in proportion to new profit sharing ratio. Entry B's capital account debit to cash or bank, whatever you want to write, you write. Cash or bank, doesn't make any difference. So amount is 20,000 rupees. Okay, these are the fundamental 7 points which needs to be covered. Thank you very much.